If you're retired or getting close, at some point the paycheck stops, but the bills don't. So at that point, the question becomes, how do you turn what you've saved into money that shows up in your checking account every month? That's what this video is about. I'll show you the system and how it works, where money comes from, what gets sold, how to handle a down market, and how you can feel confident instead of worried. Retirement income comes down to one thing: cash flow, not your account balance. What really matters is, do you have enough coming in each month to support your life? For most people, some of that comes from Social Security, maybe a pension, but beyond that, it has to come from your investments. And this is where a lot of people can get uncomfortable. For your entire working life, money flowed into your accounts. Now it has to flow out. Let's make this concrete. Let's say you want $6,000 a month in retirement. If your Social Security benefit is $3,000 a month, the other $3,000 has to come from your investments. That's $36,000 per year. And now the question becomes, can my investments reliably produce that much income for me month after month for the rest of my life? That's a very different question, and the rest of this video is going to answer it. Here's the main idea. You don't just take money out. You build a system. Each month, money flows from your investment accounts into your checking account, just like a paycheck used to. That's what creates stability and makes your retirement feel manageable. Most of the time, you'll be selling your investments: index funds, mutual funds, ETFs, stocks, whatever you have. The important part is that this should never be emotional, shouldn't be based on headlines or fear. It should be systematic. Because as soon as you start thinking, I'll take money out when it feels right, or I'm going to try to time the markets, that's when you hurt yourself. So how do you know how much you can take out each month? That's the question underlying all of this. And there's a guideline that a lot of people use called the 4% rule. The basic idea is that if you have $1 million portfolio, you can take out $40,000 per year and give yourself a raise each year for inflation and have a pretty good chance of not running out of money in your lifetime. It's a helpful guideline, but not a guarantee. What matters more is your time horizon, your flexibility, and how your portfolio is structured. So once you know how much you can take out each month, where does the money actually come from? If you've built a diversified portfolio, you already have a mix that reflects your goals and risk tolerance. Stocks, bonds, domestic, international, whatever your allocation is. The goal is to maintain that mix over time. So when you take your monthly paycheck, you're not guessing what to sell. You're typically selling proportionately across your portfolio. For example, if something makes up 10% of your portfolio, then approximately 10% of your paycheck will come from that. That's the main idea. But also, there's a natural adjustment that happens over time. Some parts of your portfolio will grow faster than others. So your monthly sales also help to rebalance things. Maybe you sell a little bit more from what's done well and a little bit less from what hasn't. But the objective remains the same. After your withdrawals, your portfolio still looks the way you designed it to. That keeps your strategy intact. Now here's where some people get nervous. What if the markets are down and I still need income? That's why a lot of retirees set aside a year or two of withdrawals in more stable assets. That way, if the markets are down, you're not forced to sell at an inopportune time. Let's talk for a minute about taxes. You'll typically have three types of accounts: taxable, tax-deferred, and tax-free. And the order that you withdraw from them will affect how much you pay in taxes over time. A common starting point is to withdraw first from taxable accounts, then from tax-deferred accounts, and finally from tax-free accounts. But that's just a general guideline, not a hard rule that fits everyone. This topic deserves its own conversation. I've done a full video on it. I'll leave a link in the description below. A little flexibility in your withdrawals matters. No plan is completely rigid, nor should it be. The idea is simple. When the markets are strong and your portfolio is doing well, that's when you fund some of those bigger expenses you've been thinking about. The renovation, the trip, something you wanted to do. When markets are weak, maybe you postpone what you can. You don't cut the essentials. Your regular income from Social Security and your withdrawals still cover those. But maybe you hold off on the discretionary stuff until things improve. That kind of flexibility can really help a plan to last. If you get this right, you can feel confident about your retirement income. You still have a paycheck. It's just built differently. If you want to see how Social Security fits into this system, watch these videos next.